Continuing on with our equity transactions, we're now looking at exercise 10-A, which builds on exercise 10-7. So in 10-7, we had issued common stock, preferred stock. We had purchased our stock back, that was treasury stock, and then we resold it. So that summary information I have over here. Let's move on and see what we have in exercise 10-A. So they tell us that this is our first year of operations. At the end of the first year, we have $160,000 in net income. We pay dividends at the end of the year, $94,500. $1 per share is what we're paying the common shareholders. And then $2,400 on all the preferred shares that are outstanding. So let's recap over here. We had 3,000 shares of preferred stock, $10 was a par value, 8% is the dividend rate for them. So let me do a quick calculation here on the side for ourselves. Let's do this calculation here where you can see this. I have 3,000 shares. The par value was $10. And I said I would pay dividends at the rate of 8% on $10. So what does that add up to? What does that become when we pay the preferred stockholders the dividends? 3,000 times 10 times 8%, 2,400. And that's exactly how much we are paying them, the 2,400. So let's first take a look at this. We have income summary debit, retained earnings credit, and this is basically to record the $160,000 net income. So again, to recap from previous chapters, what we do is throughout the year, when you have revenues earned, you credit revenues. When you incur expenses, you debit the expenses. When you do your closing entries, you close revenues and your expenses to income summary. At the end, your income summary account, you have a $160,000 credit balance, which means it's a profit. So income summary is close to retained earnings. We finally want to transfer all that number, the profits, all losses into retained earnings. In this case, it's a profit. So $160,000 credit for retained earnings. Now that I have profits, I can actually pay out dividends. So I have decided to pay out dividends. I'm paying it to the common shareholders and the preferred shareholders. Preferred shareholders, we just calculated that number to be 2,400. And that's the number we have over here, 2,400. That's how much we're going to pay them. Common shareholders, how much are we going to pay them? $1 per share. So remember, how many shares do I have outstanding? I have 94,500 shares outstanding. I pay the dividends only to the shares outstanding, which is why this calculation is important. So 94,500 times $1 is $94,500. So the total dividends we have committed to pay is $96,900. That's just adding up these two numbers. Once again, preferred stockholders, we said we would give them 8% of par value. That was predetermined. That's this calculation that we have over here. 8% of par value, $2,400. In this exercise, they told us you're paying $2,400. We didn't need to do the calculation, but if needed, we know 3,000, $10 par value, 8% gives 2,400. And dividends are paid only on the shares outstanding. So for common shares, it's 94,500 shares, $1 per share. Okay. Next, we are told that these dividends are going to be paid. And let me do the next journal entry of paying the dividends. Let's assume it happens on the same day since they haven't given me a date of record and then a date of payment. So we assume it's happening both on the same day. So that's basically just paying out these dividends. We paid out the dividends. So I have this T account here for retained earnings. The retained earnings, when I closed the revenue account and expense accounts to income summary, then I closed income summary to retained earnings. Retained earnings is going to be credited, $160,000. That's a number that's coming over here. Remember, it's their first year of operation, so they don't have any retained earnings from the year before. Dividends are always paid out of retained earnings. Now, the dividend payable account gets closed out. This dividend account that's here, I need to close it to retained earnings in order to pay it from retained earnings. Dividends is a debit balance, so I credit dividends in order to close it. And I'm paying from retained earnings, so retained earnings has to decrease, which means I debit retained earnings. So I debit retained earnings, 96,900. That leaves me with a balance. This is end of year balance, 63,100. Now, if you recall, we had said stockholders' equity has only two parts, your stock and your retained earnings. So there are two parts, the stock and retained earnings. So I'm going to bring that over here, retained earnings, and the balance is 63,100. So you had your paid-in capital, less your treasury stock, retained earnings, and this now gives you the total stockholders' equity. So if you compare your previous exercise, I'll get to that in a second over here. Let me put this in a different color so we can distinguish it. When you compare it to the previous exercise, your stockholders' equity, we had only the common stock, preferred stock, additional paid-in capital, the treasury stock, all of that information. Now in this exercise, we have retained earnings as well. This is the true total stockholders' equity number. Once you have the retained earnings number put in place, we are done with our stockholders' equity section and we are ready to prepare our balance sheet. So once again, keep in mind, dividends are paid only to the shares outstanding. So you need to know how many shares you have outstanding. Common shares and preferred shares, see how many shares you have outstanding and how much dividend has to be paid to each of those categories. Dividends are always paid out of retained earnings. Your retained earnings decreases when you pay dividends.